We're going to use par for the course, and we're going to see how to record typical transactions using debits and credits. To start, the company had beginning balances. You can see those all right here. In other words, these balances were the balance sheet from April 30th, i.e. the end of the prior month. So let's go through what the company gets and gives up for each of these typical transactions and translate those into debits and credits. The way it works is that you're going to debit what you get. And in this example, what they got is inventory. So you're going to debit inventory, and what they gave up was not cash because of the words on account. So what they gave up was an IOU. An IOU is called accounts payable in this example because it's purchasing of merchandise for credit. In the next one, what they get is $8,000 in cash. So we're going to record the cash that they got by debiting it. What they gave up was an IOU. This IOU is called notes payable. Remember that notes payable are interest-bearing borrowings, where accounts payable is basically like a credit card where you intend to pay it back within the month and with no interest. Now, as far as the next one goes, you purchased a cart for $6,000 in cash. So what you get is a cart. So you're going to debit the equipment, and what you gave up was cash. So you're going to credit cash. You can, again, like before in modules 1 and 2, we saw that you can exchange one asset for another, and the accounting equation remains in balance. Here we're paying our vendor $700 for merchandise, so basically we're going to get this IOU back, this accounts payable. Now the only thing is that we're only getting $700 of it back, but whatever you get, which in this case is the IOU, we're going to debit. What you had to give up in order to get that IOU back or to reduce that liability is cash. In this next one, we're collecting $3,700 in cash, so we're getting cash, so that's what we'll debit. What you gave up in exchange was the an account receivable. If you look back up at the top here, you can see they had amounts that the customers owe par for the course, so they're now getting that cash, so they no longer have that asset. So here again, we're exchanging one asset for another. In selling merchandise, remember there's always two entries. Let's talk about the good one first, where they're earning $5,000. What they're getting is an account receivable because it says on account. So you're going to debit what you get. What they had to give up for that are hot dogs and buns, and here we have $5,000. They call that sales because when you deliver a good or a service, you increase shareholders' equity, and shareholders' equities are going to increase with credits. Now that's it's good entry. We also have to record the fact that you used up inventory. So what we got is we got use of an asset, and we had to give up inventory to do so. So what you get is you got or consumed the asset inventory by giving up inventory. Paying of dividends, what you are in a sense getting when you pay a dividend is you're shrinking the company. You're getting back ownership. The owners have fewer claims now to the assets. The other side is cash because you give up cash. Lastly, what you do, this is the end of the transactions, is we're going to tally up what we have, what we owe, and what is the net worth of the company. So you start with, say, cash, $5,000, and anytime you see the word cash, you tally it up just like we've done before. So in doing that, here are our assets. Cash is $9,200 when you go down the column, starting with your beginning balance. Accounts receivable started with $3,700. You go down and you look for accounts receivable, and you see that it went away, but then $5,000 was created. Going on down the line, you can see inventory. You started with $1,800 in inventory. You purchased $2,200 more, but you had used $3,500, leaving $500. So I think you get the idea if you look through and take a look at each of these accounts. I'm just tallying them up. I do want to point out accumulated depreciation. In this case, it was $750 to begin with. Nothing happened to it, so we still carry that forward. Likewise with the liabilities, just tally them up. In accounts payable is $2,200. The interest payable is $165, no change, and the notes payable went up by $8,000. And then shareholders' equity, just tally up in the column what you have, and you can see it's just basically copying. So that's how you record typical business transactions using debits and credits, or translating, I should say, the accounting equation pluses and minuses into debits and credits. We'll go through the formal entries here shortly.